Here is a number that, on paper, should be impossible. There is a market rate that is supposed to carry a little bit of bank credit risk, and there is the yield on a United States Treasury, supposedly the safest asset on the planet. Common sense says the risky rate should sit above the riskless one. For much of the last decade, it has been the other way around. The Treasury actually yields more. Flip that comparison, and you get a negative number, and it has a name. A negative swap spread. It sounds like an obscure technicality. It is actually one of the clearest gauges of stress buried in the plumbing of the financial system. Here is why this matters, even if you never touch a swap. A swap spread is just the gap between two interest rates that should move almost together. When that gap behaves normally, the system's plumbing is fine. When it turns deeply negative and stays there, it is telling you something specific, that the banks and dealers who sit between buyers and sellers are running low on balance sheet room. And balance sheet room is what keeps the world's most important market, the market for US government debt, working smoothly. So a strange rate that most people never look at turns out to be an early warning light for the entire funding system. Read it right, and you are reading the health of the market's pipes. Let's rewind and define it cleanly. A swap spread is the fixed rate on an interest rate swap minus the yield on a treasury of the same maturity. For most of financial history, that number was positive, because the swap embeds a sliver of bank credit risk, and risk should cost a little extra. Then came the 2008 crisis, and the rules changed. To make banks safer, regulators made it far more expensive for them to hold assets on their balance sheets, including treasuries. Every bond a dealer parks on its books now consumes scarce, costly capital. As it became more expensive to warehouse treasuries, dealers demanded less exposure to long-term interest rate risk, and that pushed the swap rate down relative to the treasury yield. The spread crossed below zero and, for long maturities, largely stayed there. A positive number that was supposed to measure credit had quietly turned into a negative number measuring something else entirely. So what is it really measuring now? Here is the machine, and the key part is a rule called the supplementary leverage ratio. Think of it as a cap on total size, not on riskiness. It requires a big bank to hold capital against everything on its balance sheet, measured the same way whether the asset is a risky loan or a riskless treasury. For most large dealers, this has become the binding constraint, and that creates a strange result. In theory, a negative swap spread is free money. A dealer could buy the cheap treasury, receive the fixed rate on a swap, and lock in a profit as the gap closes. In practice, that trade takes up balance sheet, and balance sheet is exactly what the leverage rule makes scarce and expensive. So the arbitrage that should drag the spread back towards zero cannot be put on freely. The gap persists, not because traders are asleep, but because the pipes themselves are narrow. The spread stops being a story about credit and becomes a live measure of how much room the system has left. Here is where it gets concrete. In June 2025, United States regulators proposed recalibrating the leverage rule for the largest banks, precisely so they would have more room to hold treasuries and grease that market. One estimate put the freed-up capacity at around $2.1 trillion of additional treasuries the biggest banks could hold with their current capital. Some analyses ran higher, toward $3 trillion, roughly 9% of all marketable government debt. Traders noticed immediately. A bet on swaps outperforming treasuries got nicknamed the trade of the year, driven by exactly this expectation of looser balance sheet rules. And when the relief was slower and smaller than hoped, long-term swap spreads pushed even more negative, because the crowd that had positioned for easing had to unwind. The lesson is that this quiet spread moves on regulation and balance sheet capacity, not on the credit of banks. It is a gauge of plumbing, and right now the plumbing is the story. So here is the lens to keep. A swap spread looks like a wonky rate for specialists. It is really a dial that reads how much room the banking system has to hold government bonds. When that dial sits near zero, the pipes are wide and the plumbing is calm. When it swings deeply negative, balance sheet has become scarce and costly, and the market for government debt is leaning on a smaller and smaller cushion. This does not tell you what any price does next, but the next time you hear that swap spreads have moved, you will know what is really being said. Not that banks look shaky, but that the system's capacity to absorb bonds has changed. That is a quiet gauge worth watching. This channel explains how markets work. It is educational, not financial advice.